Now we shift gears and go over to the balance sheet. Okay, so what a lot of you had questions on what's the balance sheet. We talked about a balance sheet back in at the end of chapter 1, at the beginning of the school year. A balance sheet is just reporting financial information on a specific date. Unlike the income statement, which is for a period of time, the balance sheet is as of a specific date. It's cumulative information. It is not isolated to a period of time. So for instance, like all of you guys, when you earn money, when you earn revenue, you report your revenue from January 1st to December 31st. And then you do a tax return, right? And at the beginning of next January, do you continue to add up the money that you earned from the previous year, or do you start at zero again? You start at zero, okay? So you when somebody says they make $50,000 a year, they make that money from January 1st to December 31st, right? That's what their salary was for that year. When they get to January 1st of the next year, it's not like they say, okay, now I'm making $51,000 or $52,000. You know, like they don't keep adding to that previous year's income. They start back at zero, okay? It's not like you can say, I make $100,000 and say it's for 2 years when it's for one. It's just for one, okay? So you make $50,000, you make it for 1 year. But so that's the income statement, okay? It's for a period of time. You start the new year, you start at zero again. When you're dealing with your balance sheet, think about your cash balance in your bank account. When December 31st comes, you have $1,000 in your bank account. On January 1st, do you start at zero? No. You have whatever you had on December 31st, you still have in your bank account. So on January 1st, you start with $1,000. Okay? You keep that balance. Well, that's with a balance sheet. The information is cumulative, not isolated. Okay? So your balance sheet is cumulative. So on any specific date in time, you can report what the value of that is. You can report what the value of your car is. You can report what the value of your cash accounts are. You can report the value of what your loan balances are. They're cumulative, okay? So the balance sheet is said to report the financial condition of a company. It's the company's financial strength. It shows our assets relative to any debts or equities that our business has. If a company does not have a strong financial condition, the value of their assets is going to be weaker relative to what their debt and equity levels are. Okay? And if that's the case, then they may not have the financial strength, the financial wherewithal to weather financial difficulties or financial storms, as they call them. Okay? So you want to look at what is their debt relative to their equity and the relative debt and equity combined to the total of the assets. Again, just like the income statement, the balance sheet has 4 sections. It's got the heading section, the assets, the liabilities, and the owner's equity. We did these at the beginning of the year. Does anybody remember that a little bit? I know it was like 3 months ago, but... And again, all of this information comes from the worksheet. All the information to calculate the balance sheet comes from the balance sheet section of the worksheet. And you're going to take the information from the account titles and the balance sheet columns. Okay, so if we look at our worksheet, this is a snapshot of our worksheet. And we see the balance sheet column section of our worksheet and down below where we did the calculations for the net income. This is important. The calculation of the net income is going to be important in the final category of our balance sheet where we calculate the owner's capital. And you'll see that in just a bit. But we take all this information and we use the account titles and the balance information, and we present it in financial statement form on the balance sheet. And again, we start with the heading. We're going to put the name of the company, the title of the financial statement. And now in this one, you'll notice that there is no for the period or for the month or whatever. It's just the specific date. It is not it is not for a period of time. It's as of a specific date. And again, that's information is all centered. And then we take the information from the worksheet columns and we present it in financial statement form by putting the assets again on the left. The title of the assets is centered, and then we list the individual asset categories. Do the same thing with our liabilities. We center the title for our liabilities and put the individual accounts payable, and we put a total. Okay. We are going to then single rule underneath the totals and add them up. Then we do the owner's equity section. So now we've single ruled here, okay, underneath our total assets. We've gotten our total. Then we do our liabilities, single rule, get our total. Now we've got to calculate our owner's equity. Now if we go back just for a second, look at this number here on Kim Park Capital. And note that it says $6,474. If we go back to our worksheet, come on. It's not working properly for me. We'll go back for a minute. If we go back over to our worksheet page, what do you see here for Kim Park's Capital? Do you see 6,474? No, you see 5,000. Okay? So is that balance sheet wrong? It is not wrong. I'm going to show you how you actually get to that total on your balance sheet. Okay. So when we get to doing Kim Park Capital or the owner's equity section, we are going to calculate here Kim Park's capital. And we're going to do this by calculating, taking into consideration the net income and the drawing. Because if you notice here, do you see in the owner's equity section the drawing? Do you see the drawing? No. Okay. We do not put the drawing in the balance sheet. What we're going to do is we're going to calculate the owner's capital by subtracting the drawing and adding our net income. So we are going to do a little formula here to calculate that. Our capital balance of $5,000 that we took from the balance sheet columns, this is just showing you where you get all this. Okay, and we add and we bring this down. Take the 2,250 plus the 6474 gives us the 6,274. We add all of those up. But getting this is the hardest part here. So calculating the owner's equity is done by taking our Kim Park capital of $5,000. We're going to add to it the net income, and we're going to subtract from it the drawing, okay, to give us a total of the 6,474. Okay, so what we do here, this is going to be all messed up, but what we do here, you guys should write this down. Let me pause this for a second. This is going to be an important calculation for you to keep in mind for the rest of the year. You need to understand this concept as we go into the second half of the year in particular, because if you can't understand it with sole proprietorships, you're going to be really challenged by understanding it when we get to corporations, where the calculation is similar but more complicated. Okay? So you're going to start out by having Kim Parker's capital, which is her beginning capital. So you're going to have the beginning capital, which is $5,000. You're going to add to it or subtract from it the net income or the net loss. So what do I mean by that? I'm going to add net income, but I'm going to subtract net loss. And in this case, we had our net income from our worksheet. Remember, all of this information is coming from our worksheet. Our net income on our worksheet was $2,099. Then we're going to subtract from this our owner's drawing. We always subtract the drawing because the drawing is a subtraction from our owner's equity. Remember we said that at the beginning of the year? We said the owner's equity is reduced by the drawing. Okay? And then this gives us our ending capital. So what does that come up to? It comes up to the 6,474, which then gets put onto the balance sheet. That's the number that gets put onto the balance sheet at the end of the day. So if we go back to the other slide where we saw the net income, the owner's capital on the balance sheet, the owner's capital is a calculated number. It is not just the number from the worksheet. It's the number from the worksheet taking into consideration the net income and the drawing. Okay. The end. Okay. And then these are the key terms for this particular chapter. So let's